Let's connect with the Jakes to understand what he makes of the current market mood. Is the worst of the print for 2023 behind us? Jakes, good morning. Are you ready?
Absolutely. Good morning. Thanks for having me on the show.
How are things? No one can complain in this kind of a market.
Absolutely. I think the more, the last few 4 weeks have been obviously a kind of a trending market. But before that, I think the last year has been a challenging year. So forget complaints. I think it's a stock picker's delight and a stock picker's challenge as well to be in this market.
Picking your spots in this market, Jakes. No, my question is, Jake, so if it is a stock picker's market, where are you picking your spots in this market?
2 or 3 areas essentially. The idea here is to be not where, where the overall spaces are. We've been over the at least last few months, very, very bullish on integrated metal plays, especially steel companies that have been integrated because input prices have come down pretty sharply. And the good, the sort of troika of factors, if you will, that input prices come down, output prices also, the end product prices also have come down, but the margins have gone up, and which essentially means that from a manufacturer's perspective, higher volumes and higher margins is probably the way to go. The good thing from a demand perspective is that prices have come down, and hopefully, in an election year, in the run-up to this, where Capex is going to be the theme, or is the theme, I see dramatic new projects being announced, and dramatic increase in activity in both construction as well as projects coming through. So a combination of this means that if prices remain low, demand will be reasonably well bid, if you will. And I think manufacturers, especially in an industry which is now truly consolidated, the steel sector, I think some of the 2-3 large players, especially those integrated and low on debt, will stand to benefit big time.
Jakes, it appeared when TCS and Infosys came out with numbers that it's a sector which will go through a gut-wrenching fall and a lot of pain. But there have been outliers. Mastech, KPIT, frankly, Tech Mahindra numbers were not that bad in my book. Do you think markets are preempting a lot of bad news in IT and that may not be the reality?
I think IT could be in for much more challenging times for a bunch of reasons. At least the Indian, I would say that, I don't want to say body shopping, but those which are services driven will face challenges. There's been large-scale retrenchment going on. I think new jobs will be tough to come by. And this entire, should I say, the overlay of AI and the kind of AI ML impact that it's having in different industries. The first industry that will actually get affected in a major way, I think, is the services space. And the software services space is vulnerable. Very few Indian companies, at least not the big ones, but the mid-cap ones have actually been focusing probably a little more on the product space than the big ones. So there could be one-off names that could survive this. But I think in general, the next few years could be challenging times for the IT space. It's also the overall space for the moment. And as the money moves out from what was seen as traditional defensives, I think you will see a fair amount of money coming through into the underloved, under-owned spaces which are filled with value, like I would say Pharma till recently. It's had a move right now, and definitely the metal space.
When you say unloved, 2 names come to our mind from the Pharma pack, Divi's, which was being punished quite a lot due to API issues and China issues, and even for that matter, Glenmark. I hesitate to say that, but some part of the market thought that the numbers, all of that, the way management is conducting business, there's scope for improvement. But these two have jumped almost 15-20% in the month gone by. Is the worst over for these kind of names?
I would think so. I think there are 3-4 things that are happening. There is the European, it's called the Medicines Agency, which is the equivalent, the body which has made a few statements recently about increasing use of generics in Europe. So I think the European generics market could improve. The US market has seen a distinct should I say, easing off of pricing pressures. And as pricing pressures ease and logistics costs have come down, I think you'll find the generics offtake in the US increasing. Europe could be the other market, and I think the Indian generics players in general. I don't want to go for specific names. That's because I don't want to speak on individual names, but I think the worst is over for this space for sure. And these again, I keep repeating, these are under-owned spaces, and therefore they are prone to sharper rises when money moves in here.
Right. What about the auto space, Jakes? Two-wheeler stocks have rebounded 10-15%. That was the most unloved. Hero Moto, Bajaj, just for reference sake. Tata Motors has come back to almost 500 levels after a very long time. How are you analyzing parts of the auto space?
I think clearly the pricing pressures have eased. The concern, if any, could be the fact that demand could still take a while to emerge in a full-blown way. We've had, demand setbacks in most parts of the world. So the auto industry, which may be in a sense getting some benefit from on the cost side, still needs to see demand. And I think there is an issue. There are individual pockets where you'll have waiting periods being pretty long, etc. And of course, the onset of EV could be the other theme here, which is probably needs to be seen. But auto is not a favorite theme of mine.
Let's say if one has to understand the trajectory of the market, at the beginning of the year it was all about inflation. Thankfully that high inflation era is behind us. So what happens to the market narrative? Will growth stocks make a comeback? Will high debt companies make a comeback? Because if interest rates they start coming down, is the other end of the market, not value but growth, which comes back?
Post easy money, typically this may have been the narrative. I think while inflation in general may have peaked, but interest rates I think are not going to come down in a hurry. That's number one. Number two, post long periods of easy money, money usually moves to real assets. And therefore, whether it's a play on real estate or it's a play on Capex, my bet is that, and especially in the run-up to the general elections, the emphasis on Capex in the 1 year preceding general elections to 2 years after, in that period is usually the greatest impetus that this sector gets. So it also is, goes hand in hand with the theme that post interest rates, during easy money policy, during easy money times, money moves to financial assets. Once markets start tightening there on the interest rate side, money actually moves to real assets. So a combination of move to real assets and, as I said, this particular period of ours, that is 1 year preceding general elections to 2 years thereafter, the Capex cycle could take, could see a huge boost. And from that perspective, I think you will see commodities being at elevated prices. I don't see prices coming off. And this thesis that the worst is behind on the interest rate front may well be true, but it's not that we're going to come down to interest rate levels that we saw a few years ago.
What should be a return expectation? Let's say if somebody says 20th of August is the starting point. For next 3 to 5 years, do you think the chances of a double-digit CAGR return is not a probability but a possibility? I'm choosing my words carefully. Probability and possibility. You think it's a probability or a possibility?
In the Indian markets, I think in all markets, especially in all market cycles, especially with the tailwinds being so strong, whether it's manufactured exports, India being the chosen hub for MNCs to increase their manufacturing base here. Given all that, I think it is possible to construct a portfolio that could give you double-digit returns over the next 5 years. And I think it's not just a probability, it's a real possibility.
Construct a portfolio the N. Jayakumar way. How much of that would be large cap, mid cap? And how much would that be just hugging the Nifty?
I'm not sure if it's going to be mirroring the Nifty. This will have to be stock selection. I think given the amount of coverage there is in the market, the number of people, viewing the Indian markets, and I do believe there is maybe a year and a half down the line that this play, the tactical play that a lot of FIIs did about moving from Indian markets to China, etc. If that were to either reverse or not, at least that trend not get exaggerated, you will possibly have a scenario that some large caps could also return those. But I think in general, this may have to be, I would say, curated portfolios, not necessarily just following the Nifty. I'm not sure if that is the way that you're going to make money. It usually is never that simple. Having said that, I think the retail exposure to equities will continue to be on the rise, and there will come a time when the structural FII move to, should I say, Indian stocks will resume. We've had a long period where they've been either net aggressive sellers or at best neutral. But there haven't been big buyers in the Indian market because valuations have been a challenge. And valuations at the Nifty level have been at recent highs and not comforting enough for people to come in. So from that perspective, I would say curated portfolios are not the Nifty necessarily.
Jakes, what are your thoughts on the mid-cap, small-cap end of the market? The series gone by or the month gone by has been spectacular, 8-10% on the index level, individual stocks being done a whole lot more. Any themes, flavors from the mid-cap, small-cap which you've been studying?
I think to take a performance of these stocks in April is actually not doing the right thing, because not today, for the last 35 years, the months of late February and the entire March have been challenging. If you go back in time, March is a peculiar month because most of the funding that investors and traders gets reversed in this period, that is February 15th to March 31. From that perspective, I think a lot of private funding does disappear, and that comes back in April. And that trend is so peculiar to India. It's not true for today. It's, as I said, it's almost true for every year of the last 35 years. And therefore, you have an exaggerated move in April in these kind of stocks, the mid and small end of the market. And that, I don't think, can be extrapolated. Yes, money has started coming back. I think the backdrop is important to understand that the Indian market has become more and more a market, I would not say by default, but almost as a market that people want to have an exposure in. And in that context, the month of April, a fresh beginning, money does begin to make more exaggerated impacts in the small and mid end of the market. But in general, I would say that this is the end of the market that's also prone to highest amount of disruption of businesses and most vulnerable if it comes to that. And therefore, you need to be an expert trader or an expert investor to actually be in only the small and mid end of the market. So I think any portfolio construction would probably have 35 to 40%, if not higher, in the large cap range, and balance 50% in the small and mid end of the market.
All right, Jakes, we'll let you go on that one. Thanks so much for joining us on the show today.
Thank you.
That was Jayakumar of Prime Securities speaking about markets and the areas